Now, to your point, we did have the one big, beautiful bill. Okay, I'm not here to talk politics. I'm not here to talk the merits of the bill, because, hey, you know what? The tax cuts are great for us, right? When we go to fill out our return, we're going to pay less in taxes, and that actually benefits a lot of us. And the funny word, I think, that was attached to this bill is because the tax cuts we're talking about here, right, were the Trump taxes in 2017 were passed into, by Congress and signed into law by the president in 2017, but they were going to sunset. Those tax cuts were going to sunset. And so what we did is we took tax rates that were here and we made them artificially low, stimulate the economy and do things that tax cuts can do. We did that, but they were due to sunset this year. But then Congress met this year and there was great debate. Would we get an extension to those tax cuts? Would we go 5 years? Would we go 10 years? And where did we land? Does anybody know? Permanent. 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 Yep, they're permanent.
Well, actually, until the next budget.
Bingo. That's right. That's right. There's a CPA out of Cincinnati I mentioned up the road from me, and he was quoted in the Wall Street Journal. And you know what he said about tax policy? He said it's written in pencil. Tax code is written in pencil, can change at any point, we just need new government. And so what this bill does, though, it does give us some runway to take action. Because I used the term to describe our tax rates being low. There's an adjective I put before that. They are artificially low. Our economy does not support where tax rates are today. They are artificially low. And so that does present a planning opportunity. And that's why we're here to talk about this. I'm not just here to talk about how bad things are. Trust me. I'm here to talk about the opportunity that we have to do some planning. Okay, so could my retirement be impacted by Washington? Could it? Where does it present itself? I'm going to talk about how taxes can change, right? There's a couple of different ways taxes can change. It could just be simply, like when you think about tax rates and when we talk about the tax cuts, what's everybody think about? Their tax bracket, right? And what tax bracket am I in? And what's my income? And what's the rate applied to that income? And then that tells me on April 15th what I have to pay in taxes. Brackets, that's where everybody thinks of. But see, there's another way your taxes can change. Where'd it go? I'm missing a slide there. Tax bracket change when they just go and change the rules. Right? Congress can change the rules and they can pass new laws. They can find new ways to tax you. They can find different ways to tax you outside of just the income tax. So let's start first on just the changing of brackets. So if we had new government and new government looked at the current policy and they're looking at our budget and they say, oh my gosh, we have 4.9 of revenue and we got 6.9 of spending, we got problems, we need to fix things. If they did and they said, you know what we could do is change the brackets. Historically, I said that they are artificially low, and I can prove that by looking at the Census Bureau. So there's a census term called the middle quintile. It basically just represents the average American taxpayer. I did some work, and I looked at what the average American taxpayer paid in 2000, so just 25 years ago, and compared that to what the average American taxpayer is paying today under these current, the Trump tax cuts that were passed in 2017 and that were extended, quote, permanently. Anybody want to guess at how much higher taxes were in 2000 compared to where they were or are now? I'm talking about an effective tax rate. So if you look at whatever your effective tax rate, if you compared it to what it was then to now, for the average American taxpayer. 5%. 5%. Do I hear higher? 10%. Do I hear higher?
10%.
30. The average American taxpayer, if we were to apply the tax rates of 2000 to their income on April 15th, they would pay 30% higher than they would today. So when we talk about tax rates normalizing, That's a significant change. What could go wrong, right? What were we losing sleep over? If we are deferring taxes into a rising tax environment, these are potentially the taxes that we could be looking at. All right.
In this calculation,
Yes.
are you taking into account changes like reducing the amount of real estate tax I could deduct today compared to 2020?
Yeah, so good question. So his question is around, are you taking into account the deductions and not? No. So what we're looking at really is just tax bracket rates. And there are far more factors that go into the calculation of your specific taxes versus a broad generalization. So in order to do stuff like this, we have to keep things broad. But yeah, there are certainly other ways that are out there. All right, change brackets. As I mentioned, another way taxes could change is we change the rules. Or Congress changes the rules. Said another way, they come up with new ways to tax you. Is anyone currently on Medicare paying their Part B and D premiums? Did anybody get the surprise of Aunt Irma? Does anybody know Aunt Irma? Aunt Irma. That's an acronym. By the way, nobody knows what Irma is until you got to pay it. IRMAA, what is IRMAA? The income-related monthly adjustment amount, right? Hey, good news though, it's not a tax. It's not a tax. It is a surcharge that's applied to your Medicare Part B and D premiums that comes out of your Social Security, so net, there's less money in your pocket because of it. But don't worry, it's not a tax. It's a surcharge, right? So it does. It comes out after taxes. That's right. Yeah. All right. So IRMAA, I bring that up here really for twofold. One, for what it is, which, hey, listen, I'm gonna call it a tax. It is a tax, and when it was passed, it didn't make a lot of news because it wasn't associated with your bracket, right? It didn't take your tax rate and go from 20 to 22 or 24 or 26, but it was a way to raise revenue, right? And so, and it's actually proven to be a very successful way to raise revenue. But also, I feel like what it represents potentially is if we have a Congress, we have a new government, and they're like, what are some ways where we can raise revenue without telling people it's a tax? Well, what about these income-related things? Like, these work well, right? And so, it's not alone, right? When you start to think about when you have your income level that's on your return, they use that number for a lot of things. Income tax alone, right? The more income you have, the higher the tax rate you pay. What about Social Security? That actually just changed with one big beautiful bill, didn't it? Right? So anybody know how that works a little? No taxes on Social Security, sort of. Sort of. Right, but what do they look at to see? They look at your income, right? They're going to phase you out. If you make too much money, you're not going to get all of that. You're not going to get all of that subsidy, right? And technically, it's like it's an offset, right? It's increase your standard deduction, basically, is what they'll do, but only if you make enough the amount of money they think it's okay for you to get, right? But so income related, this falls in that category. Anybody sold any securities lately, like and had to pay a capital gains tax? What do they look at when you pay a capital gains tax? They look at your income, right? More money you make, more you pay in capital gains. Yep. And then, of course, now we got this Medicare Part B and D surcharge. It's not a tax, surcharge. And that is another new way where they're starting to raise revenue, and it's all tied to what? Your income. Right? And so that is becoming a more and more important number that is used in calculating more and more taxes. All right, so the challenge with IRMAA, I talked about legislative risk and new government government coming in and the ability to change. The challenge with IRMAA and the income related, that is already written into the law, the fact that the rates can go up. Right? The surcharge that you pay on your Medicare Part B and D goes up every single year. And it's not tied to cost of living. It's not tied to inflation. Anybody know what the increase is tied to? It's tied to experience. Meaning they look at how much Medicare was paid, right? It's calculated the same way your health insurance premiums are calculated. Like I know ours went up a lot more than inflation when I was building out our company's insurance plan, right? It is not tied to inflation, it's tied to experience. So the more people that are using and filing claims, the higher that adjustment comes. Historically, that number has been, every single year, it's gone up between 4 and 8%. I'm talking about that surcharge, right? So that surcharge has gone up. Last year, it was 5.9%. Actually, they did us a favor last year because it was low. Like the last 5 years, on average, since 2019, it's been 7.1% increase. And so when you start to think about these income-related charges, particularly around IRMAA, again, you don't know about it till you got to pay it. And it kind of smacks you in the face and you see it and you're like, man, I wish could we do something about this? Well, it's tied to income, so we can. But the challenge is that number's going up every year and it's going up faster than inflation. And so that means it's a growing impact to the bottom line if you have to pay it.